Ernst and Young recently published a study in which they made the case that taking income from permanent life insurance and annuities in retirement can create a better outcome for investors. All right, let's dive right into the study and explore the methodology they used in their analysis. For starters, Ernst and Young compared 5 different retirement strategies. The first strategy utilized investments only. With this strategy, the investor uses a mix of only stocks and bonds. They assume the investor follow the Morningstar's moderate glide path asset allocation strategy with annual rebalancing. The investor contributes to qualified plans up to the IRS contribution limit and then saves to the taxable bucket after the limit is reached. The second strategy involved investments and term life insurance. Under this approach, the investor purchases annual renewable term life insurance for legacy protection until age 65 when they plan to retire. The rest of the investor's assets are allocated towards investments. The third strategy involved permanent life insurance and investments. With this strategy, the investor allocates a portion of their assets to permanent life insurance premiums and allocates the rest to investments. The fourth strategy called for a deferred income annuity, DIA, with increasing income potential, IIP. This strategy entails allocating a portion of the investor's assets to acquire a DIA with increasing income potential, with the rest going to investments. The final strategy combines strategy 3 and 4 with the investor incorporating permanent life insurance and a DIA with increasing income potential. It's important to note that for strategies where they included permanent life insurance along with the DIA with increasing income potential, these insurance products were considered part of the fixed income allocation. In other words, they considered life insurance and annuities as bond replacements, so they reduced the allocation of bonds in the investment portfolio accordingly. One other note. They use the permanent life insurance in retirement as what they refer to as a volatility buffer. I described the same concept in my best-selling book, The Volatility Shield. That means that they access the cash value of the life insurance to pay for lifestyle needs during periods of market volatility. This allowed the investor to avoid having to access their investments when they had fallen in value. This gave those stock market assets an opportunity to recover before they made further distributions. During their study, they ran 1,000 Monte Carlo comparisons with the goal of measuring sustainable income as well as wealth to heirs. Each scenario contained a time series of interest rates, inflation rates, equity returns, and bond returns across the planning horizon. When calculating retirement income, they applied ordinary income tax rates, federal and state, to withdrawals from qualified assets and DIA income with increasing income potential. With the permanent life insurance, they assume that the investor withdraws the cash value up to basis and then takes policy loans thereafter. Each income scenario sustained a 90% probability of success or better. They performed their first comparison on the fictional couple, Mike and Courtney. They're 25 years old, have $80,000 of household income, and can save 20% of their annual salaries. Their life expectancy is 70 years. All right, let's take a look at the results for Mike and Courtney. In the following chart, you can see they ran 10 different comparisons with varying allocations of permanent life insurance, deferred income annuities with increased income potential, and investments. Their results suggest that the investment-only approach is inefficient from both an income perspective and a legacy perspective. You'll notice that the strategy that provided the greatest combination of both income and wealth to heirs versus the investment-only approach is the 30% permanent life insurance, 30% deferred income annuity with increasing income potential, with a balance going into investments. It had a 5.4% improvement in income over investments only and an 18.7% improvement in wealth to heirs over investments only. They then recast those same numbers for a 35-year-old couple, Arjun and Isabella. Once again, the portfolio that had 30% permanent life insurance, 30% deferred income annuity, with increasing income potential carried the day. They did one final comparison where they recast the numbers for a 45-year-old couple, Ben and Jen, and once again that same portfolio makeup had the best combined improvement in income and wealth to heirs over investments alone. Okay, let me make 2 observations of my own about this study. First of all, the permanent life insurance policy used in the study was whole life insurance. Because of the loan provisions, the study notes that the loans that were taken in retirement for the volatility buffer strategy had to ultimately be repaid out of their investment portfolio. The reason these had to be repaid was because the negative arbitrage on the loans would have eaten up the cash value and possibly even bankrupted the policy, incurring a phantom tax bill from the IRS. Had they instead used indexed universal life in the study, they could have shown a higher rate of return over time, possibly even as much as 2 to 3% higher. This would also have afforded them a guaranteed 0% loan provision for the volatility buffer concept. In other words, they could have taken tax-free and cost-free distributions from their life insurance, saving money on interest payments and avoiding that potential phantom tax bill from the IRS. This would have helped further preserve their assets and help provide even greater income and wealth to heirs. And so, while I agree with the broader conclusion of allocating 30% of their assets towards permanent life insurance and another 30% towards an annuity, I would have utilized indexed universal life, which would have further improved their outcome over time. Second, the tax rates they use in each of the scenarios were based on today's tax rates. Had they run an additional scenario where they showed tax rates doubling over time, they would have found that the alternative with the 30% life insurance allocation would have pulled even further ahead of the investment-only scenario. If you want to learn more about how the IUL fits into a balanced, comprehensive approach to tax-free retirement, be sure to check out my tax-free toolkit. You can download it for free at taxfreetoolkit.com. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free 3-part video series. By the way, if you have any comments or questions, feel free to drop them into the comment section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.